Assalamualaikum warahmatullahi wabarakatuh. My name is Ameera Binti Zulkifli. My matric number is 2024892228. I'm from group JBA 2423B. Today I want to present my assignment about capital structure. So the first one is, what is capital structure? Capital structure is a company's mix of capital, which consists a combination of debt and equity. It involves changing the amount of leverage a firm has without changing the firm's assets. The firm can increase leverage by issuing debt and repurchasing outstanding shares. The firm can decrease leverage by issuing new shares and retiring outstanding debt. Both debt and equity can be found in the balance sheet. Company assets also listed on the balance sheet are purchased with debt or equity. Capital structure can be a mixture of companies' long-term debt, short-term debt, common stock, and preferred stock. A company proportion of short-term debt versus long-term debt is considered when analyzing its capital structure. Next, how to determining optimal capital structure. So in determining optimal capital structure, there are many ways. The first way is company try to raise capital using debt rather than equity. It is because to avoid dilution and sending any negative signals to the market. A company that taking debt, commonly known as debt signaling. The second one is company need to think like a bank. Company need to know what is the optimal level of debt that the bank is willing to lend to the company. So the company will need to utilize other debt ratios to put the company into a credit profile using a bond rating. And lastly, to know how risky a company is, the potential equity investors need to look at the debt or equity ratio of the company. So they also need to compare the amount of leverage of other business in the same industry. So they will depend on the assumptions that these companies are operating with an optimal capital structure to see if the company is employing an unusual amount of debt within its capital structure. The third topic is factor that affect capital structure and capital structure decision. The first factor is cost of equity capital structure. Cost of equity capital. There is a common erroneous conclusion that equity is free of any cost, and it is not true. Dividend and flotation cost was included in cost of equity capital. Business development is relying only on reinvesting profits into capital, and that will reduce some financial assets, some financial risk, but decrease the speed of business growth greatly. Next, the second factor is change in control. This happened because of when equity was received from existing shareholders, problem in change in control can arise. This is because when the company was issuing a new share to the open market, there will be many new investors that will come to invest in the company. So it may lead to corporate conflicts where the stakeholders will have different opinion with one another, and it will give difficult to the company. The third factor is regulatory framework. Various regulatory frameworks often prescribe what proportion of equity a company should have in its capital structure. Raising debt also usually impose various debt covenants that restrict the proportion of debt a company is allowed to hold. In this situation, for example, banks are heavily regulated by central banks, and under the Basel III capital framework should have no less than 8% of their risk-weighted assets funded by equity capital and subordinate debt. And lastly, there are also other factors that affect capital structure and capital structure decision. For example, there was cost of debts, tax rate, interest coverage ratio, cash flow, net operating income, and capital structure of other companies. For explanation, I will explain about the cost of debt. In terms of cost of debt, the less is the cost, the more that the debt can be used. The more the debt is used, the less is the company's effective tax rate. So interest coverage ratio shows a company's capacity to service its debt by paying interest and is calculated as a ratio of EBIT to interest expenses. Next, I will explain about the financial distress. Financial distress in terms of corporate finance used to indicate a condition when promises made to creditors of a company are broken with difficulty. Financial distress also describes any situation where an individual's or company's financial conditions leave them struggling to pay their bills, especially loan payments due to creditors. The poor budgeting makes it inability to collect accounts receivables in a timely manner, which can cause severe cash flow problems, and poor accounting practices are other potential causes of financial distress. Bad decision related to marketing or pricing can also lead to financial distress for a company. An expensive advertising campaign that doesn't work or ineffective changes to a product or pricing structure that leads to a loss in sales are other potential causes in financial distress. So there are some ways to ease financial distress. For example, the first one is by cutting the cost. The second one is improving cash flow or revenues. And the last one is debt restructuring, aimed at reducing the size of debt payments. Next, integration of tax effects and financial cost distress. So in this topic, there is a trade-off between the tax advantage of debt and the cost of financial distress. So it is difficult to express this with a precise and rigorous formula. So we can look at the diagram below to see more and to know more about integration of tax effects and financial cost distress. So this is the diagram. Okay, next I will explain about agency cost of equity. An individual will work harder for a firm if he is one of the owners than if he is one of the hired help. This means if the individuals are the owners, usually they will work higher because they didn't want to fail in their job rather than they were an employee. So while managers may have motive to partake in perquisites, they also need opportunity. So some people may have their individual agenda to achieve due to the agency to achieve in the agency. So, free cash flow provides this opportunity by the hypothesis says that an increase in dividends should benefit the stockholders by reducing the ability of managers to pursue wasteful activities. So, in agency cost of equity, for example, this company recently expanded its business division. So, it will require a new management team to handle this new division. And hence, they will hire a new team. So, the expansion of the business poses an environment for information asymmetry between the management's objective in running the business and shareholders' interest of maximizing firm value. So, due to information asymmetry, shareholders of the company use monitoring tools to assess in the management if the management objective includes meeting shareholders' interest. So, this is called agency cost of equity. Next, I will explain about the pecking order history. So, pecking order history is a theory stating that firms prefer to issue debt rather than equity if internal financing is insufficient. So, managers will finance first with retained earnings, then debt, and finally additional equity issues. So, for pecking order history, there are some implications of it. For example, internal equity may be better than external equity. Next, financial slack is valuable, and if external capital is required, that is better for the company. Lastly, for the pecking order history, the evidence. So, for the evidence, the first one is size. So, large firms tend to have higher debt ratios. The second one is tangible asset, which is firms with high ratios of fixed assets to total asset have higher debt ratios. Other than that, profitability, which consists more profitable firms have lower debt ratios. And lastly, market to book. Firms with higher ratios of market to book value have lower debt ratios. Lastly, about the signaling hypothesis, the firm's capital structure is optimized where the marginal subsidy to debt equals to marginal cost. Investors view debt as a signal of firm value, which means firms with low anticipated profit will take on a low level of debt. Meanwhile, firms with high anticipated profit will take on a high level of debt. A manager that takes on more than debt that is optimal in order to full investor will pay the cost in the long run. That's all for my presentation. Thank you.